But today we're going to be talking about, well, what is the Westbridge Industrial Opportunity Fund? We're also going to be talking about why we're seeing strong opportunities in the industrial sector and what's happening in the commercial properties market in particular. Of course, we're going to go into the fund itself. So I'm going to be talking about the differences between this fund and other funds we've had, in particular benefits of the fund and the open-ended structure around it. And then finally, we're going to go through to Alex Lambert, who's going to cover off on the asset management strategy for the fund. And then, of course, we will complete that with some Q&A questions. All right, let's get into it, shall we? Let's first talk about what Westbridge Funds Management are. Look, we've been going on for over 20 years supporting investors. We've got $962 million now in assets under management, of which this past year we've actually paid out over 60 mil back to the investors. So a lot of our existing investors are quite happy at the moment. You will see that we've actually got quite a bit of sector diversification. This fund we are doing is going to be about industrial, which you can see makes up the predominant amount of our portfolio, but we have also gone to other sectors. We made a decision about, well, what, 5 or 6 years ago, Damien, about off to minimise that, which ended up being quite a good move in the end, but we'd like to get more healthcare, as you can see, and of course retail. That does include not just your retail sort of neighbourhood shopping centres, but also large format and a lot of areas like that. You can also see we're spread across multiple states in diversification. We're not just WA based, but Australia wide. If you'd like to go through the next slide, Damien, what you will see here is, yes, we've got all of our average annual total returns of our funds. Now, these are just based on our current unit price and valuations. So, of course, they're subject to you sell them, but they are a blend of both your income and your capital growth over time. The box up the top, so you can see more like with like, is our value add funds and income focused funds. So you'll see, for example, our industrial total return fund's been going for 2.5 years, roughly, averaging an annual return of about 15%. But of course, as I said, please, it does determine on when we do sell down those assets. But hopefully we've got a bit of a track record there. If you go to the next slide, you'll see we're actually supported by a very good experienced management team, as well as myself. Who's probably the weak link there, but that's all right. And what I will do is now pass you through to the main man who has all the experience, Mr. Damien Collins, to give us an opportunity overview. Damien.
Thanks, Brad. And look, yeah, I'm very fortunate here as the chairman to be supported by such an incredible team of quality people. Brad's talking himself down, but Brad does a great job with the managing the relationships with our clients. And as you can see there, right across the board, a very broad range of expertise and experience, which we all come together, and hopefully our goal is obviously to deliver outstanding returns to investors. And very excited now to be launching our latest fund, which is what we're going to talk about today, and that is the Industrial Opportunity Fund, or the Westbridge Industrial Opportunity Fund. Why did we set this one up? Well, we still believe that the industrial market has got some strength and some growth in it. We've, as Brad mentioned earlier on, when we 6 or 7 years ago, we decided that we would focus heavily on industrial. We could see the changes in the logistics space with a lot more home delivery, online ordering coming, and we wanted to focus on that. Plus, we still thought local retail would be still strong as well. And look, obviously COVID sped up that process, and no one certainly forecast COVID, but all it did was bring forward the additional demand for home delivery and meaning more logistics space by a couple of years. So we still believe there is still great strength in that industrial market. Not only is the change in logistics and deliveries continuing to grow in the US, home delivery is 20+% of all retail sales. It's continuing to grow, and it's forecast to grow over 33%. Australia, we're a long way behind, so there's certainly a significant upside. But also that is in as well as that, we've still got a reasonably strong manufacturing sector in Australia. Obviously, a lot of things we import, but there is certainly a lot of infrastructure going on around the country, and that brings in demand for industrial uses, particularly around obviously equipment and production of steel and other materials that go into all that infrastructure. So certainly there is a lot of strength there in the demand side, but conversely, we're seeing a market where the supply is still very low. Now, where people are trying to bring supply into the market, but it is still quite low, and we think that there is going to be still strong demand for those industrial properties right across the board in logistics and manufacturing in the years ahead, just simply because demand is going to continue to outstrip supply. Importantly, in terms of the fund, we're targeting a blend of growth and income. So we're looking for assets that will give us some income, and we aim to distribute that out to investors. But it is a total return type fund, in that we're targeting, as well as income to investors, we're targeting capital growth. And we're looking to get 11 to 13% per annum internal rate of return over the journey. The fund is, as I said, focusing on value add, and we'll talk a bit more further in this presentation about the asset, the first asset we're looking to seed the fund with. But nonetheless, it is a fund that's going to have multiple assets. So it's the strategy that's particularly important for investors, and it is for those value add opportunities, something where we can value add to that asset, not just rely on the income growth, but we are value adding to those opportunities. Now, something different. Most funds in property are, if they're not listed on the ASX, where they're quite volatile, if they're not unlisted funds, they tend to be closed end. That means that everyone gets out at the end of the fund when the asset's sold, and that could be 5, 7, 10, 15 years, whenever that might be. We're doing an open-ended fund, so there's two components to that. Means there'll be more flexibility on the way in, but also importantly for investors, there will be a 5-year withdrawal option, so that in 2029, if your stage of life is at that particular point that you want to get out of the fund, there will be a liquidity event, and you can put in a request for a return to get your money returned back. And now, in an orderly market, where the world's not collapsing, then that should be the goal of the trustee, being us, will be to make sure there's sufficient cash, or liquidate some assets, depending on how many investors want to redeem their funds at that particular time. So something a bit different means a bit more certainty, no guarantees, of course, because it's still subject to market conditions at the time, but a bit more certainty for investors, knowing that 5-year mark in an orderly market, in ordinary conditions, that they'll be able to get access to their money if they choose to. Now, it is only open to wholesale investors, so you need to meet that qualification, have your accountant certificate. Many of our clients already would be aware of that, but if you're unsure what that is and what you need to do, please talk to Brad or the relationship management team.
Sorry, Damien.
Yep.
Just one thing that always tends to come up is, what is that internal rate of return? Does it include the capital and income? It might be worth just touching on that.
Yeah, absolutely. So yes, internal rate of return is I won't go into the complex mathematics of it, but basically it includes the present value of your cash flows over the journey of that fund. That includes obviously the distributions, and we're targeting that 5 to 6% range for distributions. It'll depend on the assets in the fund and what we've got, but also includes the capital growth. So a lot of the capital growth will be as assets grow in value. Look, we'll certainly be looking to recycle some of the assets where we think we've maximised the value, and there might be opportunities for special distributions on the way through. But obviously that'll be based on the assets that we get in the fund. We are targeting around about $250 million in this fund over time to build it to. So there'll be a number of assets, but each asset that we put in there will certainly be targeting to meet our minimum internal rate of return benchmarks, being that 11 to 13%. So work on the basis 5 to 6% is the distribution target, and obviously the capital growth on that we are targeting to get to that 11 to 13% over the journey.
Thank you.
Yeah, one other thing too, in putting together a multi-asset fund, is that I've covered off most of the things there on this particular slide. Is that we'll obviously be targeting staggered leases, so that we don't, if a property becomes vacant, even in the strong industrial market, there's still a void there where there'll be vacancy. We might have to do some additional works, might have to offer some small incentives to get new tenants in. So we'll be targeting different assets that stagger the lease expiry, so that we don't have all the assets coming up for renewal at the same time. So that should minimise the risks, or certainly lower the risks to the ongoing cash flow by staggering those lease expiries. So it's quite a detailed strategy, not just about a buy, it's a good asset. It's got to be a good asset that fits in for this particular fund and this particular fund strategy. I've mentioned the open-ended structure. We might cover that more in detail. One of the other things that it's important to note is I'm sure many of you, the people on the presentation today, are aware of the construction cost explosion that we've seen, and there's pretty not much a better word to describe it other than explosion. It's the rate of growth in construction costs that we've seen over the last 4.5 years is hugely significant, and that's been driven by a range of things, in strong mining demand, taking out workers, the huge amount of infrastructure that governments are spending money on that is dragging workers away from the commercial and residential construction market. So we've seen building costs increase significantly. The land values have gone up significantly as well. What used to be $250 a square metre of land in Western Melbourne is now $600, $700. And that's just one example where we've seen significant growth in land values. So the replacement costs now mean that certainly helps underpin the rental growth that we've seen, but also underpins potentially further rental growth simply because the replacement cost is so high. If you're building a brand new industrial facility right now, with the cost of the building so much higher, the cost of the land, the rents need to reach a certain threshold. Now, barring an economic collapse or massive recession, it's likely that we will see those rents have to be near or above replacement costs in order to get more demand and more supply of stock in the market. Of course, if a recession happens, then things could go below that. But certainly, in fundamentally, we see there is, given the replacement costs, that rental prices for the industrial properties are still have some good room to grow. And there's also, look, the bit of the development has been in that space of the bigger sheds, but we're targeting those industrial properties more in the mid-market size. So and I've noticed that I was in the US last year. A lot of the speculative development industrial is aimed at those bigger occupiers, but a lot of the tenants out there in the market don't want those 20, 30, 40,000 metre properties. They want the smaller properties or the mid-sized properties, I should say. And so there is still a shortage of stock in those particular markets. So for tenants looking in that 3 to 10,000 range, that's what we're targeting. You can see there a lot of 77% of the leasing deals were done in that range, and we're targeting that range, and that impacts the price points that we're targeting, which is that around that 10 to 40 to 50 mil range, where we believe that there is more demand, certainly from a buyer's point of view, slightly out of the range of most owner-occupiers, not all, and slightly below most, not all, institutional occupiers and investors. Gives us that opportunity to target a market that we think is still, there are good opportunities and is less heavily covered by the private investors and also the institutional investors. Another thing in industrial property is that there is often the tenants are pretty embedded. When you look at a lot of the properties that we have, it's a huge undertaking for a tenant to pack up, make good the premises, take all their equipment out and move to another one. Now, if they were significantly expanding or significantly contracting, they're likely to, that's possible that they may do that. But if they're still needing your space, the move costs are so high that you feel pretty comfortable, as long as you're pitching your rents to them in the market range, that you're highly likely to keep them, that you'd be less likely. And so that's something we're very focused on. How sticky is that tenant likely to be? And certainly in the current market, given the low vacancy rate, the amount of quality industrial facilities out there for them to move are pretty low. There's just not a lot of good quality stock. So that's what we're targeting. properties in that 3 to 10,000 metre range, in that 10 to 40 to $50 million price point, and where there is ability to value add to those assets and much more quickly than new stock that would be brought to market. So that's the sweet spot we see in the market, and that's the assets that we'll be targeting for this particular fund. Brad mentioned earlier, look, we made that decision to really focus on industrial property for what we could see was happening in the market. More than 50% of our portfolio is industrial. You saw earlier on that we're 30+% in retail, a little bit of healthcare, only a very small percentage of our funds in office. And that certainly, we still think industrial property is a strong place to be in the Australian property market, at least certainly for the near term as well. Just want to give you a quick case study on some of the assets. We did an industrial total return fund. We purchased 3 assets. It was focused all in WA. This fund that we now have, though, will be a national fund, and will be in the first asset, which we'll talk about in a minute, that we have under due diligence is in Queensland, but we'll be buying assets all over Australia for that particular fund. But we saw an opportunity in an industrial total return fund to buy a number of industrial assets in WA, again in that sweet spot where there was some value add opportunities. We could still get some income from those assets, but we found some opportunities there for repositioning, and we bought three properties, one in Malaga, one in Welshpool, and one in Kewdale. They're all good quality for those outside of WA. They're all good quality commercial industrial precincts in Western Australia. And I'll just give you some examples of what happened with those assets. So we purchased the first one, and you would have thought, if you followed the press and given interest rate rises, you would have thought all property was going backwards over the last couple of years. Well, it's certainly the case for office, has been the case for some retail properties, and even some industrial properties have plateaued. But we were still able, in that journey, in that 2022 period through to now, buy assets that we considered undervalued, and we've made some good money for our investors in those particular funds. So the first one in Kewdale, we paid 8.1 mil in December 2022. In June 2024, we sold that for 10.8 mil, 33% uplift in 16 months. Again, if you were following the press with interest rates rising, you would have thought everything was going backwards. We gave a special distribution back to our investors for that particular asset of 40 cents per unit, which was that was obviously something they're very happy about. They put in $1. That was a 40 cent special distribution. Another one in Malaga, we bought in June 22. We just sold recently to an owner occupier for 13.65. Again, 36.5% value uplift in just over 2 years. And so we've distributed another 40 to 45 cents per unit. So in under 3 years, since the fund's been going, initial 100,000 investment has got 104,000 back already, and there's still investors still hold units in the fund of just under 30,000 based on the current unit price. And on top of that, they're still getting distributions on that remaining asset. We've got one more asset in the fund, which we will wind up at some stage in the near term, and return the balance of the capital. So a good solid fund. There was distributions on the way through, and as we realised assets, we gave some cash back. It is part of the strategy for this fund that if we do realise assets, we will endeavour where we can to return some capital to investors. Of course, that's going to be depending on market conditions, what values we get, et cetera, but we do like to return capital back to investors where we can, particularly if there's been some good upside and some good profits in those underlying assets. And as I said, that'll be something certainly we'll be looking at for this particular fund. But you can see there on the next slide, I won't go into it in huge amount of detail, but the interest rate rises that we've seen, the cost of debt initially outpaced the growth in rent, but we were still seeing good upside for industrial properties because of that strong rental growth, and that strong rental growth is now underpinned by the very high replacement costs that we're seeing. So we're cautious on particularly on the lease terms. If we think that there's an asset's under rented, we don't want to be sitting in a 10-year lease in that particular asset and being stuck there where it's growing only at CPI when the market could be growing at much more. So we're certainly one of the key things that we look at is the ability to revert back to market rents in what time that might be in each particular asset. But even though the overall yields have softened, so yeah, what the market yields, there was assets in the 4 and 5% yield range sold back and back in 2021, some in 2022. That's changed a little bit now, but even with that yields blowing out, which means that capital values technically would take a bit of a hit. The fact that the rents have gone up so much has certainly, particularly the assets that we've bought, more than offset any impact on capital value. And as you saw in those previous slides, a couple of the assets were up 30+% in 18 months to 2 years time frame on those particular assets. So look, it is, I was having a conversation with someone in Sydney this morning about the market and what they're seeing, and they're definitely seeing there's some investor interest starting to come back into the property market. So I'm sure many of you followed the press. Inflation is coming back into the range, although there's all variation of trim mean and a whole bunch of other things. But I think the outlook is pretty clear that we are going to see some rate cuts. It's just a matter of when. And what often happens then is by the time you see 2 to 3 to 4 rate cuts, which might take 12 months, 18 months, the money will be flooding back into property. Well, the smart money starting to move now. That's why we're keen to get some good assets in this fund, and particularly this first asset, to get the fund going, because we think the longer you leave it, there'll still be deals out there and opportunities, but it'll be harder to find those, and we might have to pay a bit more. So we're keen to get a good core of assets behind this fund as we start to come into 2025, and that's certainly what we're seeing out the market. The smart money is starting to come back, and I think the avalanche will come at the back end once rates have come down a long way, but nonetheless, that's where the best buying opportunities, I think, will be certainly the sooner rather than later. And I'm going to hand it over now to Alex Lambert. Alex is head of our commercial funds. He's going to talk about the asset and management strategy behind the fund. And without further ado, I'll hand it over to you, Alex.
Thanks, Damien. Yeah, as Damien said, I'm Alex Lambert. I head up the commercial funds, and probably worth saying that there's quite a big team on both the property side and the other functions that help with that sort of work on this fund and all the funds we've got under management. So in terms of how this fund structure works, I thought it might be worth just comparing. I know we've got a lot of existing investors on the call, how it varies. So I guess in terms of unit issue, look, you can put an application and submission in monthly. So we've got this initial asset, which I'll talk about in a minute, but I think once the fund's launched and established, the idea is that if you want to put some funds into this industrial opportunity fund, you put your application and your funds in the month, and then following the end of the month, units are issued and your investment's up and running. Look, there's details on how that works in the IM, but that's essentially sort of principle of it. So it means that it's probably more amenable to your timing of investment compared to some of our other ones where they're specifically asset led and timing has to revolve around that. Minimum investment 100k, subsequent 10k upwards of that, and I think point to mention on the unit price. So your application is subject to the prevailing unit price at the time. We've made the decision to start with the fund, fix that unit price for the first 12 months. The reason so is just to get those initial assets and that core stability of the fund. That sort of unit pricing, just fixing it makes it very simple. Obviously thereafter, we're targeting growth, and there'll be changing that unit price, which we'll put on our website, and that's going to be available as a monthly update on the unit price. But we will be undertaking valuations more frequently than other funds because of that unit price fluctuation. So minimum is going to be an annual valuation, but we're also going to be monitoring where we're valuing at, where we're adding value, or things have changed in the asset, or even leasing events. We'll be reviewing that as a valuation policy to make sure we can be as up to date as we can. And then the other thing, Damien touched on this, the 5-yearly withdrawals. So look, this is something we intend to offer every 5 years. There's a process outlined in the IM, but essentially we'll look to offer that to investors. We'll ask for applications, and then there's various ways that we'll manage that in terms of whether we're raising new equity, reassessing the gearing, or selling assets. And those events will be very much subject to the market at the time, how sort of events are going, but certainly our intention is to build this fund over time, and we see a lot of positives in growing that over time. But this just gives investors ability, if your circumstances are you want to withdraw funds, that application process is there. For asset selection, we'll work on this in the background as a team. Simon Worth, our head of capital transactions, is sort of doing a lot of work on the ground at the moment in terms of what we can find. But essentially our focus is income plus assets, where we want an existing tenant in an asset, or existing tenants plural, with that income stream, but there's potentially an eye for some upside through the leasing, through refurbishments. Again, I think a point of difference perhaps to some of the other funds here is that we might be a bit more hands-on in adding built area if we can in those types of assets. And I guess that moves into value add assets as well, where we might look for a bit more of an opportunity. There might be a shorter leasing or an underutilized site where the build area to site ratio could be as low as 20%, and we see that there's options to add footprint over time. So really focusing on existing sites. Certainly not.
Do you have an example of one of our assets potentially to explain that a bit better?
Look, we did buy a site in Welshpool on Orring Road, which was a 55,000 square metre industrial site. We identified there that there was some surplus land, and we built a new warehouse there of just over 3,000 square metres. So that's gone really well. We've got other examples of where we've added things, but yeah, the intention is to focus on existing sites, not new development sites, but sites that we can intensify that use, that are in a core location, and we can add that value. So in terms of selection, we're looking for industrial assets Australia-wide. Look, generally we're focusing on those core industrial areas, where there's potential infill, where there's a lot of demand, where there's a lot of tenants, where all the infrastructure's there. As I said on the slide before, if they're land rich, even better. We've got the opportunity to look at possible expansions. Yard space in the market is also very sought after at the moment, so you can also get good rents for that in the interim. And certainly we're looking for assets that can be below replacement costs, with the build cost that Damien highlighted. Certainly there's lots of examples of that. Strong fundamentals is something that we say a lot. I guess, what are we talking about here? We're just talking about things that appeal to these industrial occupiers, and that's high truss heights. In terms of workshops, that's cranes. In terms of logistics, the ability to racking and sort of good fire precisions for those warehouses. So all those type of specifications that tenants want, we're certainly looking for that. Or if they don't have them, we're looking for the ability to add that to increase rent. We're targeting that mid-market, so it sits below the institutions. And Damien highlighted in some of his slides, where that demand is. Certainly this year, there's been a real strong demand in that 3,000 to 10,000 square metre range from tenants, and we see that being less fed by developers, and that 10 to 40 million asset value sort of sits along with that size range. And the value add, it's really sort of focusing on where we can probably roll our hands up, add value through leasing to increase income, add built area, do refurbishment, or potentially, just increase that specification of these warehouses to get income and capital growth over time. So the first asset, look, this is a great land holding. This site is a couple of kilometres from the Gateway Bridge in Brisbane. Australian Trade Coast is named, and the location is Pinkenba within that. What we really like is good land holding. There is an underlying land value of 50% of asset value. we're buying it on what we see sort of a slightly softer yield than perhaps there have been examples of in the market. And it's a really strong tenant, HMG Hard Chrome. They're owned by a big international, and they've been operating there for a long time. Our indication is, look, they want to be on that site for the future, but it's also a sought after location. You know, if they were to ever relocate, I think we've got various options of what we could do with the site. So I guess the point is, for the first asset, we've got a great income stream for roughly the next 3 years. We think there's a lot of flexibility. The tenant's got some very specialist equipment. They're very well embedded in the site. We certainly want to talk to them about how things look in the future. And from our initial indications in due diligence, certainly those doors seem open. But should they not want to stay in the future, we also see it as various options for multi-tenanted or other single occupier workshops. There's certainly a lack of supply of those available in those locations, and something that's located near the airport, located near the port, and only about 10 kilometres from the CBD. So really like this asset, and we think it's a great asset to launch the fund with. And then looking ahead, so what are we targeting? Well, we want to build that income stream initially. So certainly well-leased industrial assets for the short to medium term. That income plus type asset I mentioned earlier is on the target. We'd like to get 3 or 4 good income producing assets up in the fund, and then as we establish that income base, look to blend in some of those more active opportunities where we can add the value through refurb and through expansions and leasing and other things. So really getting that blend together, which will target that IRR and try and push that up so we can get those target returns we're looking at. And certainly along the way, we mentioned the potential for special distributions, and that target is, as we're able to realise some of that value through the assets over time, we'd look to make those where we can on the back of that successfully achieving upward valuation or increase in income through those value add opportunities. With that one, I will hand back to you, Brad, to run through this.
Thank you, Alex. I appreciate that. Now, thank you all. I'm getting a lot of questions here, but before we get into the questions, I just want to say, look, we will once again be recording this, and give us a day, but we will be able to get it out on demand for anyone who would like it. So please reach out to us if you'd like to either express interest if you haven't already, or you'd like a copy of the recording. We'd highly recommend you read right through the IM for all the more details. And once again, you can come direct to any of ourselves at the Key Relationships team for that. All right, we'll go straight into the questions. And now we are not going to answer them all. There's way too many coming through, but I'll start straight off. Back when we were talking about the case studies, what is the typical capital gain realised by most of your funds? Is this case study typical of that? Damien, did you want to cover off on that?
That was the Industrial Total Return Fund. Look, we've sold other assets for, we just sold one in our Diversified One Fund for 30 mil that we paid 11.5 million for about 6 or 7 years ago. That was obviously a very, very strong one. Look, our track record was in our commercial funds was back earlier slides. If you have registered for this, you'll get a copy of these slides. You can see for yourself all the different funds and it's also on our website how they've performed. Certainly, we're very very confident in our ability to select good quality assets and realise good value from those, and that's been certainly our track record here in commercial funds. Look, nothing's guaranteed in life, but certainly we feel confident. We've got a great team who not only acquire the assets but also manage them well. So, but you can judge for yourself based on the track record of those funds that we've got, as I said, on the website or back further in the slide pack.
Yeah, we've also tried to bundle them like for like as well. So the value add and income based ones, which are similar to this product, we've tried to bundle so you can see more specific answers. Another easy one for Alex Lambert. What's the LVR of this fund looking like? So loan to value ratio.
We've got a bit of a range and gearing target from 40% to 55%. it will fluctuate over time. Obviously, with the open-ended nature of funds coming in, one of the things that we'll do with funds until they're deployed into a property is put that into the debt facility to offset that effectively. So it will vary, but that range is sort of 40 to 55%.
Fantastic. Now I'll go an easy one first. Damien, are you able to invest via an SMSF entity?
From our point of view, absolutely. We have lots of clients who invest through their self-managed super funds. So from our end, we just need, if you haven't invested before, a copy of the trust deed and other formalities that we always require. But in terms of your own super fund, you should check with your advisor if you have one and the trustee. But generally, you'll find that almost all super funds would allow, the trustee would allow for investments in these type of assets, but certainly talk to your own advisors about that.
Fantastic. I'm going to bundle a couple of questions here for Alex Lambert here. I've got a couple, one in regards to does the asset flood? Another one talking about do you do contamination testing and things like that before you go unconditional? I'd like to bundle it and say, well, let's look at the bigger picture, not just on this asset. But Alex, what do we look at when we're going through our due diligence on these assets?
Look, whenever we're acquiring a property, we agree due diligence period, essential to do our homework on it effectively. So, look, that involves getting technical consultants on board on built form, environmental. We look at any contamination issues, what they are, through to any materials in the building that such as asbestos and things like that. So look, we've got a pretty rigorous due diligence process. They're in all our contracts so that we can make sure that we can know what we're buying, do our homework as such, and if there are anything that comes up that do have cost effects, then we can make sure we have that in our cash flows. And sometimes that does mean that you have to go back to the seller and talk about price. So look, we've got a rigorous process and certainly go through that with a lot of detail.
Yeah, I've got another one here. Do you check the financial statements of the tenants? I'm assuming that's covered as well. You do quite a bit on the tenant side.
Certainly where we can get hold of them, it does become more complicated with private entities, but yeah, we do as much homework as we can. Often we'll have meetings or calls with tenants to run through their financials, and we'll ask for as much as we can, and sometimes we're limited by what they'll disclose. But certainly with listed entities and everything else, it's much easier for us to do our due diligence on that. But yeah, we'll always be asking those questions.
And I think important to note, this first asset, Alex, is a subsidiary of a much bigger group, isn't it? A widely regarded group. Single just talk about the tenant. It's one of obviously many assets we're going to put in the fund, but you might just talk through who the current tenant is.
Yeah, so we've got HMG Hardchrome, and they're basically bought out by Sun Derby, who are a listed entity on the Malaysian Stock Exchange, and they're a big behemoth internationally. So they're a huge company, but underneath that, HMG Hardchrome has been operating for a very long time on this site, and they're a specialist that provide rods and sort of mining equipment to all the big names in the industry, and certainly they've got a very strong name within that.
Great. I've got three separate ones, all very, very similar. And for Damien here, basically asking, do you need to be a wholesale investor to invest, and how would you define it?
You do need to be what's considered a wholesale investor. So that is the definition in the Corporations Act and regulations. So effectively it means you'll need a certificate from your accountant, and you'll need to qualify under one of four things. The first one is income more than 250,000 per annum. That's gross income, not net. The second one is it's an all net assets of more than 2.5 million, or invest more than $500,000 in one line into a fund, or be deemed to be a sophisticated or whole investor based on your previous experiences in the fund. But the first three are the general, where 99% of people do qualify. They go and talk to their accountant, and so it is only available to wholesale investors.
Got another one for you here. It's asked multiple times, and Simon, you know who you are. Yours is a bit more detailed, so we might have to go offline for it. But in regards to, is the fund tax effective?
Is that for me or for?
Yeah, for you. Sorry, Damien.
I'm
For
happy to
you.
answer that one.
You're an accountant.
I
Or
am a
chartered.
reformed accountant, Brad. I
Reformed.
still, although I still am a member of the Institute of Chartered Accountants. Look, in terms of tax effectiveness, what you're getting at is there building depreciation? So I guess in summary, and it'll depend on funds and the assets that we get. If you buy an asset, there is depreciation on the building component, not the land. So effectively, that might mean if you've got 6 cents distribution, you might find that potentially, I'm just throwing numbers out here as an example, 4 cents of that might be taxable, and 2 cents of that might be tax deferred. But we get, look, I wouldn't be, this is not a tax strategy fund. We would certainly hope to get some depreciation out to our investors and shelter some of that income from income tax. Of course, our investors in their self-managed super fund and pension phase may not be paying any tax anyway, but it's more a value add fund. So there'll be a little bit of tax sheltering, but it's predominantly more focused on the capital value and the value add and the total return. I wouldn't anticipate, given the type of assets that we're targeting, there's going to be huge amounts of tax deferred income. Alex, you've obviously got a bit looking at all our funds and seeing the distributions go through. Anything further you wanted to add on that topic?
No, I mean, there will be, certainly we'll look at some modern assets and you'll get the depreciation benefits, but certainly there'll also be some older assets that we're looking to refurb. That's part of the strategy. So yeah, what you're saying there, you might get slightly less depreciation benefits on those older assets. So look, I think, yeah, that aligns with what you said.
Okay.
Yeah. And should there be special distributions, how would that be treated generally?
From a tax point of view, so that'll be so the fund,
obviously it'll vary, but
if the fund makes a capital gain, then that is then distributed to investors. So they will then get a statement on a tax statement saying, hey, the fund made a capital gain. If you own 1% of the fund, you get 1% of the capital gain. So generally, though, if it was just a straight, for example, revaluation and return of capital, so let's just say an asset went up in value, we took some extra leverage against that and returned capital back to investors, that would not be taxable. That would just be a reduction in the cost base of the unit. So it'll depend on asset by asset. So I can't give a 100% answer on exactly what will be treated tax-wise. But if we sell an asset, make a gain, everyone will share in that capital gain for tax purposes. If we revalue and return capital, that wouldn't be taxable and reduction in the cost base. That's generally how it will work for these types of investments.
Nice. Back to the assets. So Alex Lambert, one for you. How do you find your assets to purchase?
So look, between the teams, so we've got Simon Worthy heads up our capital transaction team, and then Aaron, who works with him, and there's various guys that work behind, but a lot of it's through those relations. And I'd say, 60-70% is off market in terms of sourcing those sales through known contacts across Australia. And I think that's one of the things for this fund. A lot of the assets we look at aren't just on an open market campaign that everybody can look at. So it's a big point of difference. Now, sure, there's other funds that can also sort of tap into those off-market opportunities, but certainly we see a lot of things that you wouldn't see if you're a mum and dad investor in terms of them trying to buy something. So that's a benefit. And there's also on-market stuff, but yeah, as I say, over the past few years, certainly we've been around 70% off-market transactions.
Excellent. Here's someone who's thought a bit deeper. So what happens if you get too much equity capital coming in without the assets? I can cover off on that one quickly. Essentially, there's quite a number of things that we've got to do to be able to help with that. One would be potentially not taking as much debt on an asset when we do that, to reduce the debt to equity ratio and allow that LVR to drop, but to keep obviously that income up. There's other options like term deposits. We can go into other of our funds short term to provide extra income to keep that fund at that thing. And of course, we do have the option to stop that monthly income of equity coming in if we have to keep that balance so that nobody is disadvantaged. Anything else to add on that one, Alex?
No, I don't think so. I think, yeah, as you say, there's a management process for that. Certainly, we're going to be actively looking for assets, and as a team, sort of those communications are open of what's up and coming, and we'll be working those management flows, and we're setting up our finance facilities for that ability to, repay debt when if we've got that equity sitting there and we're not ready to deploy it for 1 or 2 months, and then reset that on the next acquisition.
Fantastic. Here's an interesting one for Damien. In capital letters, unlisted, not on the stock exchange, question mark.
Yes, so I'm not entirely sure what the question is, but I'm guessing
I'm assuming they're trying to work out the unlisted pulp side of it.
So there are funds listed on property funds that are listed on the stock exchange, but the value of the units is determined by the stock market and not by the underlying, not entirely by the underlying asset value. So it could be that they do trade at sometimes 20, 30%. Even I've seen as bad as 40% below the asset value. So if you want to exit at a period of time, yes, it's more liquid on the stock market, but the volatility could be significantly greater. But our funds are unlisted, so at an exit point in the future, if someone at that 5-year liquidity event, it would be based on the underlying asset values, less disposal costs that the units would be priced at. So it's not subject to the stock market fluctuations, but more aligned to the value of the underlying assets. But having said that, yeah, you can't get out on a daily basis. So they're property trusts or property funds, but they're unlisted in our case, and compared to the listed markets.
Fantastic. And yeah, I have to admit, a lot of the investors really enjoy the idea of it being unlisted and not having that peace of mind of having to stress daily what's going on. So I see that. There's quite a number in regards to the 5-year redemption withdrawal period. Can we go into a bit more depth on that, either Damien or Alex?
I'm happy to
Sure.
to go into depth. So effectively, there will be a time period that before the 5-year mark where investors, if they want to get out of a fund, out of the fund and want to get a return of their capital, they can nominate and elect to redeem their units. Now, it depends on how many people want to redeem those units. So if we have a very small percentage of investors who want to redeem their units and the other, everyone else is happy to continue on, and there will be more liquidity events every 5 years, then if a small percentage of investors want to get out, between the cash flow coming in from the monthly new investors coming in, we would hope we'd be able to manage that and redeem those units within an orderly period. Of course, the more investors that want to get out the particular time, if that involves selling assets, then we do have a time period, and it's in the IM and Constitution. If you want to read that, we do have a time period in order to redeem that. So we're not fire selling assets and disadvantaging the investors of staying on in those funds. So well before that 5-year mark, we'll certainly be in touch with the investors. Brad and the team regularly talk to our clients, and we'll be talking to them to get a gauge on who wants to, if any, to the extent people want to get out, and that will impact the time period for when those units are redeemed. And of course, if 50% as an example of investors said, well, we want to redeem, well, would more than likely, then we would probably sell most of the assets and wind up the fund. So it's in the hand of investors, and it will be assessed more at that time. But it's the extent, the more investors who want to get out, the longer it will take to meet those redemption requests.
Fantastic. All right, I think that covers it. It's question here. The minimum says 100,000. However, am I able to top up in later months less than 100? A quick one for that one. The answer is yes, definitely. If you've got 100,000 in there in your initial investment, and you've got another 10 grand to throw in the next month, by all means, you're welcome to. It's a quick, easy process through our portal. And as for your existing investors who know, it's probably once you've got all your details in the system, it's probably less than 3 minutes to get it all done and dusted. So it's a very easy process. Last question for Damien. Is there a limit to the amount of assets you will acquire? Sorry.
Well, we're targeting around 250 mil as the total fund that we'll be looking at. So that could be somewhere between 10 assets and 20 assets potentially. It'll just depend on what assets that we find. We're aiming in a multi-asset fund to get some diversification across the states and the tenancy mix as well. So there's no fixed or hard cap. That's our target at this stage. But we'll assess it as we go along. But I would anticipate somewhere between maybe 8 and 20 assets is probably where we'd likely get to over the years ahead.
Fantastic. Now, I've still got a heap of questions here, and we're obviously not going to be able to get to, so apologies for anyone we've missed. Those with names against, we will be following up with calls just to make sure you're comfortable. We'll answer those questions for you. Thank you, Damien.
Thank you.
And Alex, thank you very much.
Thanks, Brad.
All right, next steps. Most people would have registered their interest already, but if you haven't, please hop onto our website. You will see there's a register interest button. You can click on there. At that point, you'll hear from someone within my team to answer any questions you've got, whether it's high level, talking about the funds in general or this fund in specifically. Can answer anything you need with us. It's from a very educational point of view, so most people do take that up. Otherwise, we'll also send you the full information memorandum, which is the full documentation. It also includes your ability to fill in an application form. Most people now are using our online portal, which is very quick and easy to use. But if you're a bit not tech savvy, as I should say, we've got a whole team here to help you through that as well. So do not worry. And we've also got manual application forms if you need as well. Once you log your application form, as Alex Lambert was explaining before, at the end of each month, we will then issue we'll take the applications for the month, and the beginning of the next month, we'll be issuing the unit certificate, from which case you're an investor and you start receiving your monthly distributions and those regular quarterly updates that we send out. Of course, you're also welcome to hear from the relationship team at any point as well with queries on the way through.